Welcome to the book club interview. My name is Scott Hollister, your host. Today's guest is Amanda Han of Keystone CPA, who is a tax strategist who specializes in creating cutting-edge tax-saving strategies for real estate investors. As a real estate investor herself, Amanda has an in-depth understanding of the various aspects of investing, including taxation, self-directed investing, entity structuring, and money raising. So welcome to the book club, Amanda. How are you doing today?
I'm doing very well. Thank you so much for having me, Scott.
Thank you for being on the show. First off, amazing book on tax strategies. I love the title, for the savvy real estate investor.
I have to be honest, the the title actually was created with the help of the folks from Bigger Pockets. So
Awesome.
yeah, they really they were kind of the brains behind that title for me. But I do like it, and real estate investors are generally some of the most savvy and creative people I know.
Yeah.
And so I thought that was pretty appropriate.
Definitely. No, spot on. And I love the introduction message from you. I think, I found it really refreshing that, you told us what the book was going to be about in the beginning, and you really, put forth, what you were going to learn. And, I read a lot of books, and that one that just is stuck with me. So I just want to say thank you for that.
Great,
Yeah.
great. I think the inspiration was, as a CPA, I read a lot of books as well, and I try to read up on a lot of books about taxes and what strategies other CPAs are using.
Yeah.
And one day I was reading a book, and I realized that I was falling asleep reading this tax book for real estate. And I thought to myself, as a CPA and an investor, if I'm falling asleep, I can imagine a non-accountant reading it and really enjoying it. So I thought, I want to write something that's a little bit more fun, a little bit more plain language, I guess, where
Yeah.
people could read it in a story format, so we're not all falling asleep reading all the the code sections and all that stuff.
Yeah, no, I think it came across well as a reader of someone who's not by any means, code savvy. So I think it was, I think we can take a complex idea and really explain it simply with a lot of examples, which you did in the book. I love that. Those examples really, you get the concrete information and you broke it down, and I'm like, okay, as a former teacher, I was like, this is an awesome teacher. So it
Yeah.
was great.
Cool.
Yeah.
Cool. Glad you did.
Yeah, so in the book you said you worked for one of the largest and most prestigious accounting firms in the world. And I'm really wondering, what was the turning point when you said you learned to use the tax code to build your own wealth? Was it like an aha moment?
Yeah, it's interesting because I kind of grew up around real estate, right,
Hmm.
with my parents and my grandparents, um, and even though I grew up in that environment, my parents never really taught me about real estate. They weren't like, oh yeah, you got to do real estate. It's more the traditional like, hey, get a good degree, get a good job, and that's kind of going to be the way to go. But interestingly enough, I was reading Rich Dad Poor Dad, which I'm sure
Yeah.
you've read before. It's so interesting. So for myself, that was kind of the aha moment.
Hmm.
It just in thinking about things differently. And it's really weird. I almost feel like for me personally, I had the Rich Dad and the Poor Dad in one person. It's just that my Rich Dad was not teaching me in the Rich Dad format, and I had to go out and buy a book and learn about it.
Yeah. Yeah.
Um, but yeah, that was definitely the aha moment. And, after I read that book, I started to look at my work from a different set of eyes, instead of just doing someone's tax return and, kind of checking off the checklist. I started to look at what was actually happening for my real estate clients.
Hmm.
And I was lucky enough to actually be working in the real estate section or real estate department of that firm. So it was, kind of an easy transition for me. But for me, it's just really a different way of looking at a client's tax return and seeing, oh, wow, they're making so much money, but they're paying a lot less taxes than, this other client here who is working and not doing real estate. So that was sort of how I bridged the gap and, just try to mimic, how can I use the same concepts and methods to help myself in, in building wealth, essentially.
Of course, and I love this strategy, the title you had. So what you don't know can hurt you. And you talked about
Hmm.
being stuck in that rat race, together with your husband Matt. And I love the actual number. So you said together that you're making over 200K a year, and you're paying another 50 in federal income taxes, another 16,000 in state income, another 14K for payroll, and another 3K for property taxes. So all said and
Hmm.
done, roughly $90,000 a year in taxes. So one half of the marriage is working just to pay taxes. Um, what did that do for you mentally?
Yeah, I mean, it's just sad, right? I
Yeah.
think, have you heard of Tax Freedom Day?
Yes,
Have
in
you
your
heard of that
book.
term
Yeah, but
before?
before that,
Yeah.
no. Yep.
So yeah, so tax freedom day is interesting. I think you work sometimes you work through April, sometimes you work through May, and you realize, okay, well, everything I've earned so far is going towards taxes. But yeah, I think for us and it's obviously it's not the same way for every single person.
Mhm.
There are people who make other types of income or who are single and a lower income where they're not paying close to half of their money to taxes. But yeah, definitely for us, living in a high taxing state, being a married couple, both earning fairly decent W-2 for the time being, is fairly shocking. And I think that's the thing is a lot of people don't really look at taxes that way.
Mhm.
It's kind of like we get a paycheck and we glance at what was taken out for federal and state purposes, but maybe we don't. It's kind of just like, okay, direct deposit, there it is, and you just kind of live off of you get used to whatever the net paycheck is. But I think a lot of people are always shocked to figure out, to actually see how much the taxes they're actually paying.
Mhm.
I talk to clients all the time when I tell them, hey, you know what, you're in the 25% tax rate, but your actual tax is probably closer to 35, 40 because we have to add in, payroll and state and all of these things. And it is somewhat of a shocking or depressing
Yeah.
to kind of, face.
Yeah.
But I think, knowledge is power. If you don't know it, we kind of just complacently work, pay taxes, spend the rest of the money. And, if we're lucky enough to understand investing, then, start putting money away for investment purposes. But,
Mhm.
kind of knowing the details behind the numbers forces us to take more of an action to say, okay, am I okay with this? If not, what can I do to make things better for myself?
Of course. And so, what type of client do you focus on? And I know you said this in the book along, CPAs have, work with a multitude, but it sounds like your business structure is more, narrow focused.
Yeah, and I think we've been fortunate enough at Keystone CPA where both Matt, my husband, and myself come from real estate background when
Mhm.
we used to work in the big accounting firms, and to be able to continue to focus on that, combine that with our personal investment, our personal quest for expanding our portfolio, and really be able to kind of focus our clientele around those people who either currently invest in real estate or have goals to have real estate as part of their portfolio. It definitely helps, I mean, as an advisor, it definitely helps when we specialize in a
Mhm.
particular niche rather than to say, well, I can take on clients from manufacturing and restaurants and real estate because taxes are so complex that gosh, actually I was taking a training yesterday before our call. I was to get training yesterday just on the tax reform that came out in January 2018, and that was a 2-day, 8 hours per day training in talking about all the various tax changes. And so for us, we're lucky that we can really dive in and focus the time specifically on real estate, depreciation, 1031 exchange, and all those things that are focused on real estate, and not have to worry about all the changes to like foreign
Mhm.
taxes or manufacturing and all of those things.
Yeah. No, it's amazing. I think that goes, if you can create a little niche as a business and really become an expert, I think you're going to attract the best clients as well. Um,
Yeah.
so, this book is broken into 5 parts. In part one, you wrote about deductions. So, what are some of the most common deductions investors might be missing on their tax returns?
Yeah, that's a really great question. What I see, For the most part, real estate investors are really great about capturing common expenses relating to their specific properties. And what I mean by that would be, when we own real estate, we all know we have to deduct property taxes, we have insurance expense, we have mortgage interest, and management fees. So I would say the vast majority of clients are pretty good at capturing those, although from time to time I do still review a tax return and I'll ask them like, hey, how did you not have insurance? Or hey, did you not pay property tax for some reason? So they do get missed from time to time, but for the most part, everyone is pretty good about that. But I think outside of that, what people generally are missing are what I call overhead expenses. So that means those are expenses that you are incurring because you're a real estate investor, but they're not necessarily specific to a rental property. So an example might be, you're working with an attorney to form an LLC to hold your rentals. So that might not be specific to Main Street property, but it's still, you're forming it because you own real estate. Or, marketing fees for anyone who's, if you bought a tax book, for the savvy real estate investor, right? Yeah. So tax books, education classes, or if you're going to a local real estate club meeting and, you have dinner afterwards, or the drive to the real estate meeting, those are kind of the things that I see missed more often because people just aren't sure, can I deduct it? Or maybe they feel like the amounts aren't that big, so you kind of, tend to not track it. But I think it's very important, again, going back to the tax rates, if you're someone who's paying between 30 to 50% in taxes, if you accumulate $100 worth of business expenses for these overhead items, it's going to save you from $30 to $50, right? So it's fairly significant.
No, it's a good point. And is there any way to, make accounting for taxes like a daily part of our life?
Yeah, I think the one thing I encourage people to do is to look at yourself as a business owner. And when I say that, I don't really mean, having an LLC or having a corporation. If you're someone who owns real estate, whether it's for rentals, fix and flip, wholesale, if you're someone who is earning income in real estate, then you're technically a business owner in the eyes of the IRS. And so as a business owner, one of the things that we should be doing, is to train ourselves as part of everyday life to ask ourselves the question, when we spend money on something, the question you ask yourself is this expense a reasonable deduction for my real estate business? So if you're going to Costco and you're buying a case of paper, for example, right? The question is, okay, well, is it reasonable that a real estate investor would need paper to print stuff from? If the answer is yes, then you want to track that expense, keep a copy of the receipt or at least take a picture of it, so that you can potentially take the tax deduction. And then when you meet with your CPA, you can give them a list of all of these expenses that you have. Now, worst case scenario, they're going to look at it and say, oh no, that's not really a legitimate business expense because of XYZ reason, right? But at least you have that conversation. On the other hand, if you bought paper and you didn't even track it, your CPA is not going to automatically say, oh, hey, Scott, did you buy some paper the other day?
Yep.
And so the opportunity gets lost. I would say, part of daily life is just, train yourself to think like a business owner and to ask yourself, when you're spending money on something, especially when it's a significant dollar amount, like if you're going on a trip or you're, spending $5,000 on this class, ask yourself that question of, is it reasonable that I would have this as a real estate investor?
Yeah, no, that's a great question to ask. I think it brings a reflective process out of you, and it's important that you do treat yourself like a business. So those are some good tips. And you mentioned a business trip. So are there any proactive planning tips for taking a business trip?
Yeah, that's a great question, especially for summertime. From a trip perspective, one of the main things the IRS looks at is what is your intention with respect to a trip. And when we talk about deductions, whether it's regular expenses or business trips, you always want to look at it from an audit protection perspective, right? Which means, if I were audited, what would the IRS want to see? Okay. So if it's a situation where you're going to a friend's wedding in Florida, while you're there, you happen to look at some real estate, maybe the time driving from the hotel to the property viewings would be tax deductible, okay? But the flight to Florida, or the hotel in Florida would not be deductible because what you're doing is you're going there for a wedding and you happened to be doing some real estate.
Hmm.
Okay. On the other hand, if it's a situation where before you left for Florida, you've already scheduled to attend some local RIA meetings, you have a few appointments with local realtors or maybe potential investors already scheduled, then it is a lot more likely that you can deduct part or all of your flight and hotel costs. And the difference was that, in the first scenario, we were going to a wedding, we happened to do real estate. In the second scenario, it's that we were going to do all the real estate stuff. Maybe we happened to attend a friend's wedding,
Wow,
right?
interesting.
So the key, yeah, so the key really is the term I look at is predetermined business activities. And predetermined is a key word because it means that we have to schedule these things, or we have to have documentation that these were scheduled before we leave for the trip, because that's how you can support in an IRS audit that the reason I went to Florida was because of A, B, C things that I did for my real estate.
Yeah, so it's important that you have documentation. So that's a very good note. In terms of the home office, so roughly 26 million Americans have home offices, and almost 87% of those people, may be missing out on deductions. So what are the common ones?
I think for real estate investors, I think you're right. The home office, especially for real estate investors, now a lot of people work remotely, but I don't really know a lot of real estate investors, especially landlords, who go out and rent an office to manage their real estate portfolio.
Yeah.
Right? Most of that could be done from their home office. One of the perks of having rental income and the mailbox check stuff. So I think the most common issue I see is not so much like a missed deduction on missing out on one thing or another. It's more of just people are still afraid to take the home office because maybe 20 years ago the IRS came out with announcement that, hey, we were going to audit the home office, but that was back then before telecommuting and remote work environment was so easily accessible. So I think a lot of maybe tax advisors or CPAs are still holding on to that old threat, and then somehow that's passed down to the clients and the taxpayers, and then the taxpayers are still afraid of that, that old audit flag. But I think the reality is that, you probably already know this, but the IRS has made it easier for us to take home office deductions. In fact, several years ago, they came out with a standard method where you can deduct, based on the square footage and no receipts or anything needed. So I think it's more of, some people are still holding on to that old scare tactic from the IRS instead of just updating their thought process along with the IRS to say, okay, this is not really something we're going to focus on anymore.
Yep. Yeah. No, growing with the times. Yeah. No, I've heard that a few times. Like, don't take the deduction. You might get audited. I'm like, oh, okay. But yeah. No, I love, like you said, knowledge is power. And, the more books you read and you pick up these little common tips and you learn as you go. So.
Yeah. I actually talked to someone recently and I said, how come you don't take the home office? And he said, my CPA told me it's sort of like an insurance policy. So if I do get audited, then I can say, well, hey, look, I was really good and I didn't take the home office. So do I get some brown? Like, I don't know. I don't know if that works that way.
Yeah. I doubt the government's going to let you slide on that one.
Right.
Yeah. And so, moving on to part 2. So entities, you had a couple great chapters in here. And before we get to the legal entity lies exposed, which I love, by the way. So what are some common do's and don'ts with LLCs, partnerships, and corporations that you see?
Yeah, I would say so. Two main things. First, do not form or dissolve any kind of entities without talking to your advisors. And generally, that means your CPA and your attorney. Okay, because I think one of the biggest mistakes I see is, people read a book or attend a seminar, and then they go out and form a bunch of entities or dissolve a bunch of entities. So try to not do that. You want to do it under the guidance of a professional, because sometimes forming entity, it could be costly, dissolving it could be costly, any kind of mistake could be very costly. So it's definitely worth your time and whatever the fee might be, to talk to your advisor before you go out and actually form or undo entities. The other common mistake I see is not using the legal entities correctly. And I probably, in terms of new clients that I talk to, I probably come across this issue at least once a month, where someone formed an entity a year ago, 2 years ago, 10 years ago, and they're not using it correctly. So this is so fresh in my mind because I talked to someone yesterday
Good.
who had an entity, and it was just terrible setup. So if you're forming an entity, just make sure you're using it correctly. If you're supposed to pay from the entity, if you're having income earned inside of the entity, having title held in the entity, just some of the basics of actually using it. Because a lot of people will form an entity, you have this really beautiful entity binder that's leather bound and gold letters, and then they put that binder on the shelf, and that's not really doing
Yeah, yeah.
anything from a protection or tax savings perspective. So I think those are the two most common things I would say to watch out for.
Great. Now, legal entity lies exposed. So, a great chapter. So, what lies do you hear most often?
Most often, and I don't, gosh, I hate using the word lie, because if it's all intentional or not, but I do have clients who, maybe go to a seminar and are told, or at least led to believe, that they need to form an entity immediately. And once they do that, they will get all of these tax deductions magically appear. And I think that's one of the biggest lie or your miscommunications out there, because from a tax perspective, the IRS actually does not care whether you have an LLC, a partnership, or a corporation for deduction purposes. What they look for is whether or not you have business activities. So, an example might be if, Scott, you're not doing anything at all. You're just sitting there, you want to do real estate, but you haven't really done anything at all. And then someone said, hey, go ahead and form an LLC. You could start deducting everything under the sun. Well, that would not be accurate, because you're still not doing anything in real estate. So the LLC is the LLC, but we still can't prove that we're actually in the real estate business. Versus another example, if, Scott, you own a bunch of rental properties, they're all in your personal name. Well, again, if you go to Costco and buy some paper and supplies, or you hire an attorney or a CPA, these are all tax deductible, even though you don't have any legal entities and you're just operating in your personal name. So the IRS looks more at, are you in business of earning income, more so than do you have an LLC or do you have a corporation. So I think that's something that really gets to me, when I have a client who says, oh yeah, I spent $3,000 forming all these entities, and I'm really excited because I'm going to pay no taxes this year.
Oh,
And then to say, well, let's take a step back and make sure you're doing real estate first, right?
Yeah, yeah.
before you spend all that money, make sure we're actually doing real estate. So I think that's probably one of my biggest pet peeves about entity lies.
I love it. Add it to the list.
Yeah.
So how do we wake up from our bookkeeping nightmare? And how many investors have you met that said they enjoy bookkeeping?
Oh my gosh. Well, so in our firm currently, we probably have about 500 clients, give or take. I have one client who enjoys bookkeeping, and I love. She's so good at it. She loves it. I told her, she wants to kind of learn more, I would refer her to other clients who need
Yes.
bookkeeping and hate doing it. So yeah, very, very small percentage of people who actually love doing bookkeeping. Most people, it's kind of, a necessary evil, I guess, as a business owner / real estate investor, we do need to be able to somehow keep track of all of the expenses we were talking about earlier, because if you're not tracking it, then it would get lost. So, if bookkeeping is really something that you dread or is very difficult for you, I would say, with anything else, just set up a system that works for you. It doesn't mean that as a landlord, you have to become a bookkeeper. You have to know how to work in QuickBooks or Excel or something like that. But you do want to have a system so that you are able to track all of the money you're making and spending. And it could be as simple as a folder, right? A folder, I'm putting all of my receipts in here. And then having someone, whether it's, like your child or hiring an administrative person to then help you itemize or list out those things.
Hmm.
Or, I have clients who still want to handwrite stuff, which is fine. They can you can handwrite whatever you spent the money on for each property, and then someone can summarize it for you at the end of the year. But the key is having a system in place so that you're tracking all the expenses that you're incurring,
Hmm.
because you're the one incurring it, right? There's not like a second person who's doing all this for you, unless you're fortunate enough to have a full-time bookkeeper on staff, which most of our clients don't.
Hmm.
But as long as you have the system in place, it does make your life a lot easier. And the other thing I would say is do your bookkeeping often. If you're doing it once a year, odds are those days you're spending on bookkeeping is going to be miserable, because you're probably not going to remember what you spend money on, what that receipt is for. But if you have a good system where you're kind of trying to, organize it once a month or once every other month, then it generally is a lot easier because the transactions are still fresh in your mind, and oh yeah, I went to Home Depot for Main Street property and here's what I did,
Hmm.
instead of coming back 12 months later to take a look at what that was.
Yeah. Oh, come on. That day's fun in late January, going 24 hours looking at receipts. Oh my goodness. Yeah. Been
Yeah,
there.
exactly. I know I was going to say, sounds like you come from experience.
Yeah. So any good software? I know you mentioned QuickBooks, and I think that's part of the reason that helped me a little bit moving from like an Excel file sheet. But is that something that you recommend
Yeah.
clients?
That is a really good question. So I know a lot of CPAs recommend QuickBooks or
Mhm.
certain types of software. I don't particularly I don't particularly have a preference on whether someone uses QuickBooks or Excel or handwritten ledger.
Mhm.
Um, if you're going to use a software, if you're someone who's software savvy, that's perfectly fine. QuickBooks is one of the better softwares out there that's still user friendly.
Mhm.
Um, but I would say what you should use for your bookkeeping should be something that you're comfortable with. Because again, the,
Mhm.
the goal is for you to be using it consistently. So if you're someone who does not like software, does not like technology, what I don't want to happen is you go out and buy QuickBooks and you again put it on the shelf, probably next to your LLC binder,
Yeah.
and then continue to just ignore everything on a day-to-day basis, right?
Yeah.
So yeah, I would just say it's kind of a personal choice. If you're really great at Excel, or Excel's easy enough, or even Google Docs, if that's easy enough for you, then that's fine, go ahead and use that. Maybe you have one sheet for each property, right? And you just enter your stuff in as you get the receipts come in. And or if again someone who's more into handwritten ledgers,
Yeah.
we have a few of the clients. Yeah, as long, if you have a notebook that you just write in, that's fine too. It's whatever method works for you within your system, because the key is that we want it to be something that you're using throughout the year.
Oh, that's smart. And then what do you look for in terms of the investor? Obviously something that's, legible that you can read. But, obviously do you look for like organization, and you want to, do you tell your investors, a sample criteria sheet that you make sure we have these item numbers?
Yeah, great question. So, for our tax return clients, what generally we do is we'll send them a template profit and loss,
Okay.
which is sort of similar to what you might find out in QuickBooks. It has the listing of categories at a higher level that we would want to see. So, rental income, repairs, improvements, mortgage interest and
Mhm.
insurance and all that stuff. And that's just kind of a reference guide, like, hey, here's the level of detail we need.
Mhm.
Now you can go further than that. I have clients who, instead of just repairs, they want it broken out by all the kitchen repairs and all the bathroom repairs, and or they do it by cabinets versus flooring, which is all great. But yeah, we do give our clients a template so they know, okay, here's kind of the level we need. You can go into more detail if you want to, but you're not required to,
Mhm.
based on what we need for reporting on the tax return.
Oh, it's great to know. Something that's, fond of everybody. So part three, retirement planning. I love this quote you started with. It said, "Why diversification is only required when investors do not understand what they're doing," by Warren Buffett. So I think it goes back to your business model of, becoming an expert in one area as opposed to, being scatterbrained. So I loved it. It was a good
Yeah,
kickstart.
it's really interesting, and not necessarily related to the retirement part specifically, but people talk about diversification in stocks, and that's great. It's a little bit different, I think, for real estate. I was talking to a client the other day who has, investments in a bunch of different states, Florida, Michigan, Texas, Tennessee, Arizona, and he was looking to diversify into more states. And I told him, that's all great, but whenever you go to a new state, a new market, you have to do your due diligence, learn the people, build a team on the ground. And then also we have to file tax return, right? So now instead of just having two tax returns, federal and state. Now you have federal and 6 states. So that's another downside of wide diversification when it comes to real estate investing.
Simplify. Love it.
Yeah.
You gave an example of, with a gentleman named Roger, someone who left the corporate world for a full-time real estate investor and agent. And it took a few years, but eventually he replaced his corporate income. And one year he netted about $90,000 in profits, but the bad news was almost $30,000 in income taxes to the IRS and state. So what type of, retirement account planning did you recommend to Roger?
Yes. And, for someone who has a significant amount of net profit in any given year, retirement planning is always one of the tools that we look at. And of course, we look at maximizing deductions and all of that. But retirement planning is one of those ones that you get a big bang for your buck if you're utilizing it correctly. So in this example, one of the things we recommended was a solo 401k. Also, some custodians call it individual 401k or individual K. These are all just, branding names, essentially. Essentially, what it means is a 401k for a small business. And small businesses generally means that, the owner / employee are, one and the same people. What we really like about that is it allows you to put the maximum amount into retirement. I think for this year is just around 55,000 that you could put into retirement account, get a tax deduction for it, and then that money that's in the retirement account grows tax deferred until retirement. So that's one of the things that we always look at if someone is, had a good year and is trying to lower taxable income. Now, one of the issues in the past that I hear people say is, Amanda, I love to, put 50,000 in retirement, save $25,000 in taxes. That all sounds really, really great, but I want to use my money for real estate. And so there's sometimes a disconnect of, okay, if I fund it and I don't have money for real estate. So one of the best things about the retirement world is that, now everyone is getting more and more information about self-directed investing, which really just means that you can use your retirement money for real estate as well, and you're not limited to just the stocks, bonds, and mutual funds. So it's kind of the best of both worlds, right? Get the deduction and be able to use it for real estate.
Yeah, and I love the side-by-side comparison of, I believe it was the Roth IRA, or but the deduction. I mean, it wasn't even a deduction because you're taxed before you're put in, and I think the limit was around $6,000. And it seemed like the solo 401 had a lot more flexibility, and just like you said that if we lock it up then we can't use it, but if you can self-direct, I think you can be pretty savvy around that. So
yeah, and for the 401k or the solo K, one of the really great perks about that it has over like an IRA, for example, is that you can actually use leverage within that account and not have any, hidden tax issues. So what I mean by that is, if let's say this year, you had a really good year, Scott, and we said, okay, you should put 50,000 in the solo 401k. With the 50,000, the 401k could go out and get a loan from private lenders or banks and buy a property worth, 150,000, let's say, right? And now you have this property worth 150,000, all of the cash flow and appreciation is growing tax deferred in your retirement account. Which is really powerful because we don't necessarily get to see that when we invest in mutual funds, right? Or stocks. I mean, if you have 50,000, you're buying $50,000 worth of stocks. You're not buying $150,000 worth of stocks.
Yep.
So it's a really powerful strategy, because especially as I know, real estate investors are all about leverage, right? Leverage, accelerate returns and all that. So it's a really great way to do that within a retirement account as well.
And I'm sure you get bombarded with questions all the time, but this is one of my favorite answers in the entire book. And, in terms of the tax code, and it says you must know how to apply the code to your particular situation. So, I'm sure with all those millions of questions throughout the year, so what's your best response to those questions besides, it depends?
Oh my gosh. Yeah, I know it's so tough because people hate that answer. And I
Yeah.
actually hate it. When I talk to attorneys, they always tell me, well, it just depends on this, 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 and this.
Yeah. Yeah.
But that really, I mean, but that really is the accurate answer
Definitely.
because, what might work for you, Scott, might not work for the next, the investor next door to you.
Hmm.
So I think that the key is really making sure that you're working with your tax advisor,
Hmm.
and that your advisor understands your overall financial picture. So meaning it's, so it's not just someone you go to in April to get your taxes done. When you get your tax returns done, that's really just kind of after the fact reporting. You're just, reporting what happened last year, but really to be proactive, before you buy a property, before you refinance or pull any cash out or move property to an LLC. Those are the times when you can get some more proactive advice
Hmm.
from an advisor to say, okay, here are your options. And the answer still might be it depends, but
Yeah.
at least it depends on what your decision is. So we might say, okay, Scott, you sold this, you're going to sell this property. You're going to pay some taxes. Here are the taxes you might pay. You can either do this or that,
Hmm.
or option number three. And which one will it be? Well, it depends, right? It depends
Yeah.
on what's most important to you. Is it to get the cash? Is it to pay off debt? Is it to reinvest? And from there, you can get, a more educated decision that you would make ultimately.
Yeah, and that sounds like the answer from an expert. I mean, and that's my next question leading up to is how do we know if we're working with the right tax advisor?
Ah, good question. Um, well, first off, I would say if you are investing in real estate, or if your goal is to, have real estate be part of your wealth building portfolio, it's really important to make sure you're working with someone who understands real estate.
Hmm.
So you don't want to be the one explaining real estate to them per se. You definitely don't want to be the one to convince them that you want to invest in real estate. And I see this a lot. People say, "Oh, I told my CPA I want to do real estate," and they told me, "Well, here are all the issues with real estate," right?
Hmm.
So that's first and foremost. I think someone who understands your business, whether that's real estate or manufacturing or whatever it is.
Yeah.
So that's the first criteria. The second part, I think, for me, the right advisor is someone who is on the proactive side of things. Again, it's great to have someone file your tax returns. There's not a whole lot of value in that because you're just reporting what's happened in the past. The value is in working with someone proactively throughout the year so that you know what are your options, what should you be doing before the year is over or before you head into a transaction. So, if you're interviewing advisors, that those are the things I would want to find out. Like,
Hmm.
well, how, if I have questions, do I have access to you? When should I be calling you? How do I get charged if I'm calling you?
Hmm.
What are some things that you would want to know when I'm doing, right? So these are things that you would ask to see if it's someone that's proactive in helping you plan, or is it a CPA that is basically there January through April and then they close their doors during the summer because they're going on vacation, right?
Yeah.
Then that might be problematic because you're in a transaction. It's like, well, my CPA is, in Lake Tahoe and I can't reach him.
I'm sure that vacation is rightfully earned though after April.
Yes, yes, yeah, yeah. You just want to make sure it's someone who is there year round,
Yeah.
like as you have needs that you can help them. I mean, for us, for our clients, we don't require meetings every month or every
Mm.
week or every other month, because sometimes if you're not in the middle of a transaction and there's nothing new going on, there's no reason to meet,
Mm.
right? But on the other hand, we always tell our clients, if you have something going on, send us an email. It could be two sentences, or we can get on a 3-minute, 5-minute phone call and say, "Hey, Amanda, I'm doing this. What do you think?" Because those are the times when it's important for us to be involved. When you have transactions, then we can tell you, "Oh, here are the opportunities," or, "Oh, no, here are the pitfalls. Let's talk through these before you actually pull the trigger."
Mhm. Oh, it's awesome. I love those tips because, everybody's going to need to, find an expert that, works for them and is going to be proactive in the process. So that's great. Now, part 4, IRS pitfalls. Love the chapter on depreciation. I thought it was well written and explained in very simple terms. And like I was saying in the beginning, that to me is a sign of a great teacher. And there's so many complicated things, and once you can really understand it and put a grasp on it, which this chapter did, it helps so much. So how do we as investors take full advantage of depreciation, and what is the quick overview? Because I know it can go. Yeah.
Yeah, depreciation is simply what I consider an IRS loophole, where the IRS says, okay, if you buy property and let's say the building's worth $100,000, I'm going to let you write off the value of the building slowly over time, regardless of whether the building is appreciating or not in actuality, right? So what happens is then, if we buy $100,000 property, we're writing off part of that little by little every year, but in reality, hopefully the investment itself is going up in value and we can refinance or we can sell it down the road. So it's really a paper write-off that we as real estate investors get by simply owning rental properties. Now, as investors, to take full advantage of depreciation, well, one thing is you need to own rental real estate. And by own, I just mean, you have to be holding title to the property, right? It could be fully financed. It doesn't have to be all cash, but you do have to own it. Let's say if I was to get into Airbnb situation, I lease an apartment and I sublease it out on Airbnb. There is no depreciation in that scenario because I don't actually own the real estate. So that's a key, is making sure that it's, we actually own the real estate to be able to get the depreciation benefit. Outside of that, really the depreciation benefit is something that should be done by your tax advisor. It is very complicated in how to kind of take advantage of it. There's so many loopholes, and there's actually even more now under the tax reform on how to take advantage of like 100% bonus write-offs or, immediate write-offs under Section 179. So there's so many things that I think it's probably not super relevant for an investor to understand. But going back to, making sure you work with the right advisor who deals in real estate and knows how to take advantage of those. I think the only action item I would say as a real estate investor for depreciation is to keep good records of what you're spending money on when you're doing improvements. So, if you're doing the buy, rehab, rent strategy, instead of telling your CPA, hey, I spent $100,000 in improvements, you want to itemize that $100,000. So maybe it's made up of $3,000 of flooring, $6,000 of cabinets, $2,000 in furniture and fixture. That level of detail will allow your CPA to help you maximize your depreciation write-off. So really, I think that's really my only recommended action item from the investor's perspective.
Great. Now, how do we gift properties to our family and not the IRS?
Good question. Good question. Well, seeing that we pay the IRS every year in terms of taxes, right?
Yeah.
What you want to do is make sure that the real estate itself is not also gifted. Usually when we talk about gifting, it's planning for older investors, part of estate planning. How do you leave real estate or other assets to your kids? And one of the things that we look at, and again, it really depends on every person's situation, but generally speaking, when you're someone who's younger, meaning you have many, many years left before you, expect to potentially die, and or you have young kids, those are the years we actually want to hold on to our properties and not gift them right away because we want to keep the tax benefits. So depreciation being one of the examples, right? We said if we own real estate, we get tax write-offs. Well, if we start to gift the write-offs, if we gift the properties to our kids, we're also gifting the associated write-offs, which is not what we want because maybe our kids are still in school or they just have, low income that they're making at their job. So those are the times when we still want to keep the assets to ourselves. Now, when the kids are older, when we're getting ready to retire and plan to leave things to the next generation, those are the times when we want to start gifting properties to the next generation, because maybe, when we're retired, we'll have lower income taxes and the kids are in their prime, income earning years where now they would want the write-offs. So those are some things we look at in terms of how and when do we gift properties to our family members and not to the IRS. When we talk about gifting to the IRS, it's really for those people who've had no planning at all whatsoever. And, at the end of the day, then the IRS is going to take a chunk of it and then the rest will go down to the kids.
Yeah. So well said. So being proactive for those times. So, before we wrap things up, I have a couple of random questions. Just one out of curiosity. So how crazy was the new tax law, and did it throw you through a loop this year? Were you pulling your hair out around that time?
Oh, well, good question, because like I said, I just finished the training that I did that I took a class on tax reform.
Yeah.
It's definitely crazy. A lot more changes than what we anticipated. I have to say, though, from a real estate investor's perspective, and by real estate I mean landlords, flippers, wholesalers. Most, if not all, of the changes have been good. So the expectation is that for investors and business owners, the overall tax liability should be reduced when we compare that to, if there was no tax reform. So that's the good news, is that I think ultimately all the changes that we're seeing are actually going to be good for the taxpayer. But yes, the downside is it's definitely going to be a lot more complex. I know, we heard about simplifying the tax code. That's definitely not the case. If anything, it's gotten, 10 times more complex with the different credits and the flow-throughs and how you're going to calculate. And I think what a lot of people don't know is, even as of today, there are still a lot of unknowns that are part of the tax reform. So there's still a lot of clarity that we're waiting for the IRS to give us guidance on. We hear about, okay, here's, part of that income for flippers, for example. Maybe the first 20% of your income would be at zero tax. But there's still a lot of questions. Well, what's your definition of income, right? Is it after retirement contributions? Is it after you pay yourself? What are all the details of that? So those are really kind of the nitty gritty of what we're waiting for. And we were supposed to know by August. So, August is coming up real soon. So hopefully the IRS will meet their own internal deadline. But those are the things that we're looking for. And I think, when we talked about proactive planning, something to be done, definitely very important this year for people who, again, are flipping, landlords. Before the end of the year, it's important to make sure you meet with your tax advisor to figure out what are some moves that you can do to make sure you take full advantage of the tax reform, because it could mean, tens, 20s, tens of thousands of dollars in differences, depending on what kind of entity you're using or how you're paying yourself, from your real estate transactions. So exciting times, but yes, also pulling hair out.
That's good. Well, it sounds like it's going to be, you as a property owner as well. I think you're going to, it sounds like you're a little bit happy about it, but like you said, little speed bumps, and once you get a better grasp of it, that's good.
Yeah.
So one more life question. So how does it juggling, the family around, both of you are, in the same business. And I know, that time around April is just absolutely crazy. So do you find that you juggle it well? And how do you balance that life business aspect is the question I'm asking.
Yeah, I know it's tough. I guess it can be tough. Especially in our business, we're so deadline sensitive.
Yeah.
I think one of the things that we've done that's helped out a lot is kind of going back to proactive planning, because as a firm, we specialize so much in proactive tax planning that for the vast majority of our clients, April is not a surprise to us. You know, it's
Okay.
not like, oh, this is the first time I found out you did a 1031 exchange and, you sold one property and bought 20. It's something we would have already known, in the prior year when it was happening. And so yes, even though April is still a big deadline date for us, we are able to actually do a lot of the work up front. So, right now, if I have clients doing 1031 exchanges, I'm already getting the closing documents. I'm already getting the package. We're already doing all the numbers, so that by April, that piece of it is done. Maybe we're just entering like a W-2 or, the management reports and things like that.
Yeah.
So it's, I think we're fortunate enough in that it just happens to be the way we've built our business that
Yep.
by being proactive, it doesn't only just help the client, it helps us too. So we don't have any surprises and we can accelerate stuff where, maybe for some other CPAs that are just really slow, during the summer months. Like right now, we're actually fairly busy.
Yeah.
Everybody here. I mean, we don't have anyone working overtime now, but we're still, consistently busy because we are already planning for next tax season.
Yeah.
So yeah, it definitely helps. But outside of that, I think it's part of the growing pains, of being a business owner and just understanding that those are the months that, you're not going to go on vacation.
Yeah. Yep.
Maybe order takeout more and
Yeah.
then, and then we'll just get better after that.
I love it. It's so simple yet so profound, being proactive. So I think that if I walk away with one tip, that sounds like, because I mean, if you said it's the proof is in the recipe, and it sounds like you've managed what is typically crazy or what people tell you, and you found a way that works. So great for you. It's awesome. No.
Thank you.
Well, thank you so much, Amanda, for being on the show today. I really appreciate it. If you want to tell the listeners where they can, find out more about you and where they can purchase the book.
Oh, yeah, definitely. So our company website is keystonecpa.com. That's www.keystonecpa.com. And we have a lot of free resources, downloadable ebooks and things like that on our website. So I definitely encourage people to check those out if you haven't visited before. And yes, we're, if you have not read our book, Tax Savvy or Tax Strategies for the Savvy Real Estate Investor, it could be purchased on Amazon as well as biggerpockets.com.
Great, and I highly recommend it. Amazing book. Like you said, you read so many dry books and you didn't want it to be that way, and I think this is a great book for investors to really understand, and you can have that more proactive conversation with your CPA. So I think that will go, a long distance in a real estate career.
Thank you so much for having me.
Thank you, Amanda. You have a great day, and we'll talk soon. And that concludes our book club interview with author Amanda Han, who wrote the book on tax strategies for the savvy real estate investor. This book contains so many powerful techniques that anybody can use to deduct more, invest smarter, and pay less to the IRS, which is surely what we all want to accomplish. There's so many great topics in this book. You'll learn creative ways to maximize your tax deductions, clever ways to write off your kids, strategies to write off every penny of your travel, easy tips and tricks to cut down bookkeeping time, and simple ways to protect yourself from an IRS audit. I highly recommend it. I think Amanda did a wonderful job with her husband of writing it to someone who doesn't like to read those dry books. So she did a wonderful job, translating all that information that's useful that we need to know so we can communicate with our CPA and tax strategist to choose our best path as real estate investors. Highly recommend you get a copy. Definitely a great book by a great author and someone who's very knowledgeable in the industry as well as an investor, which I love. So check her out. Make sure you like our Facebook page so you can stay up to date to the authors that we're interviewing and the content we're putting out. That's it for today. My name is Scott Hollister, your host, and we'll see you next time.